All right, guys. Some of the information that we're going to go over is gonna be you're gonna overlook it at first, but you got to stay with me and see the whole picture. Trading really is simple when you break it down to it. Once you get past all the mental games that goes on, I mean, you can really learn trading in just a few weeks' time. It's the head games that your mind plays on you that really hinders one's ability to perform well in the market. And everybody's been there before, myself included. I have bad days, but I'm a lot more controllable now than I was when I first started, not knowing what you don't know. So, all right, so let's go ahead and get started. Now, this slide right here, guys, where it says everybody can see it, unbelievable trading strategy that made $104,000. Let me see if he's in here. Yes, he is. So, oh, no problem. Thank you, Sarah. How I actually found this strategy, which, I'll show you the caveat behind it when it's all said and done. This strategy was just to prove to somebody about how simple trading can be, and that's what made me really want to put this webinar on and share this with as many people as possible. I mean, this is truly something that can impact your life, but we got to start from the basics and actually build upon it to show you guys. For any of you guys that are wanting to trade the bias or some of my levels that I showed from the previous week, you need to have these foundations before you can even think about trading something like that. You need to make sure you put yourself in a position to win and not really to have the market beat you up. Another side note, if my voice starts cutting out, I came down with a cold last night, probably about 1:30 in the morning. So I got some pretty good cold medicine in me right now, so hopefully we'll make it through this without my voice cutting out. I think I should be okay, though. All right, so before we get started, we have the normal disclaimer. There's high risk in Forex. You can lose a lot of money. You can make a lot of money. Consult your financial advisor before placing any trades. And we're not going to be giving any trade recommendations on this webinar as we speak. So, all right, here's a little bit about me for those of you that don't know me. We do have a few new faces in here. So for those of you that don't know me, my name is Mike Schwartz. I've been trading for roughly about 10 and a half years. I started out trading stocks, options, as well as futures before I really found a home trading in the Forex market. I really love what the Forex market has to offer. You can check in on your trades at night. You can manage your positions. You don't have to wait for the market to open. The only time we're susceptible to gaps is really over the weekend during this current time. And a lot of times I'll close my trades out on Friday. If I have a big profit in it and I'm going for a bigger move, then I'll keep it open over the weekend. But for the most part, I try to close most of my trades, Friday before the market closes. All right, so we're going to talk a little bit about money management. And this is so important that so many people overlook. I mean, this is one of the biggest factors that's going to impact your trading. That's going to dictate if you're going to be a success or a failure when trading. And here's some of the ways that money management affects traders. The first, it has a direct effect on your P&L. Now, if anybody thinks that that's not true, please send me a text in the chat box. Because as this presentation moves forward, I will prove my point, hands down, what money management can do for one's trading account. It also affects the trader's psychology, which we just talked about a little bit. Being scared to take the trade, taking profits too early, all the mind games that really go on in a trader's mind. I mean, it's very easy to place a trade. Think about it. All you're doing is clicking a button. Click a button, get in, click a button, get out, or click a button to get in and have your stops and targets already preset. All right, here's the effects on the returns. Here's how it does it. Poor reward to risk example, a poor reward to risk. Here's an example. A trader risking 60 pips to make 20 pips. This is a losing scenario. Now, you may laugh at this and say, ha ha, who would do this? Go out there and look on the internet. You probably get the same junk in your inbox as I do. And you'll see people touting a high win-loss ratio. But, you got to look at the reward to risk factor, what they're achieving. Now, if you're getting a 90% win-loss ratio and you have a positive risk to reward ratio, or even a 1-to-1, I mean, that would be great. But when you're going negative on the risk to reward, that's not a scenario where you're going to be in the game for a long time. Could you have some good runs? Yes, but when the market turns, your account is going to suffer a pretty good drawdown. Now, here's another effect. Think about this. You have small winning days and bigger losing days. How many times have you guys made, let's say, $50 in one day, and then the next day you lose $100, $200, or even $500 the very next day? All this leads to poor psychology and, the fear to be able to place the trade, or the confidence you have to really trade in the proper trade location. All right, it's very, very important to keep your money management under control. We're going to show you 2 strategies within this webinar that will show you it is possible. All right, psychology. We kind of touched on it a minute ago. Money management can affect the trader's psychology by causing a trader to take profits too soon. That's that trader that, maybe when you first set the trade up, you say, hey, I'm going to get in here. I'm going to risk 20 pips, but I'm going to go for 40, which is great. You got a 2-to-1 risk to reward ratio. That's awesome. But then as soon as the market moves up 5 pips, starts to stall a little bit, they say, uh-oh, it's going to come down. I don't want to have a loser. Let me go ahead and take my profits. Okay, so you take your profits and you're like, whew, that was good. I made a little bit of money. I feel good about myself. And then you watch the market march all the way up to your target. How good of a trade was that really? Because in the scheme of things, to really let the model play out for you, you have to take and let your profits be able to hit the objective. Just because you set it there, if you don't give the trade an opportunity time to get there, then you're doing yourself no favors, and you're actually having a negative risk to reward ratio over the long term. Causes a trader to trade scared. Think about this. You see a trade setting up. Yes, there are, Keith. Hey, are you guys seeing the slides, by the way? I want to be real clear. Is everybody seeing the slides progress? No. All right. Well, good that I looked at the chat log. So here we'll go. Okay, so we're going to go back a little bit. I'm a little rusty, guys, so bear with me. Okay, so here's where it was money management after the slide you guys seen. Here's where we talked about, here's where we talked about how it has a direct effect on your P&L, affects trader psychology. Here's where it talks about the negative risk to reward ratio that I just verbally went over. And thanks again, guys, for go ahead and let me know in the chat box. I'm a little rusty, so that's one of the downsides of not putting on a webinar in a while. Here's where I talked about, you have smaller winning days and then bigger losing days. Everybody, yeah, cold medicine. That could be it too, Joe. I'll blame it on the cold medicine. Small winning days and bigger losing days. That's really going to be key to a lot of new traders, I feel. You feel good one day because you made a little bit of money, and then the market just really kicks you in the gut the next day and takes back more than you made the previous day, and then some. Psychology. This is what we're talking about. I think this is where we left off. Causing a trader to trade scared. And I think this is where we're at when you guys said the slides were not progressing. So causing a trader to trade scared. Let's say you had a signal saying, when it can even be stochastics, let's say. Stochastics crosses back below 80, you take the trade to the downside. So, last trade you did, it didn't work out for you. Now you start getting a little bit scared, saying, hey, this trade may not work out. Well, it doesn't matter if this trade works out or not. This is just one trade in the big scheme of things. Okay, this is just one of many trades. The sooner you can learn not to take that trade personal, the further along you're going to be in a much quicker time. And it took me a while to get over this. Remember, guys, those of you that have known me for a while know it took me about 2 years before I became consistently profitable. It took quite a while. It's still a learning process every day, every week, every night. Also allows doubt to set in. So think about this. Let's say you backtested whatever strategy that you want to trade, and you say, okay, it has a win-loss ratio of 60%. I should make 3 or 4% of my account per month, whatever the number is. Okay, so you did all this backtesting. You've seen it. This is what the results should be. Well, and then you start tweaking it. Oh, I'm going to get out early. I'm going to get in a little later. I'm going to get in early. I'm going to go ahead and move my stop loss up faster than what I did during my testing. You know, you have to be consistent with your process. If you're not consistent with your process, you're never going to achieve the same type of results. And that goes back into being scared. You know, if you have a true strong belief, then you're going to believe in your system and you're going to do what is right. Fear to take a trade. Now, I never really suffer from this one. I've talked to a lot of traders out there, and they're just so scared to put a trade on, where me and my partner Scott that trade, we were just opposite. We got into the trade way before we should have a lot of times, you know, because I wanted to participate in the market. I like the excitement of it. I wanted to make sure that I had the opportunity to make money. And that's the wrong way to think too. Both ways are bad. You can't be scared to take the trade. You can't be too anxious to want to jump into the trade. You have to make sure the conditions are met for whatever system that you back tested. This works universal across every trading strategy there is. Fear of causing a trader to enter a trade too late. So think about this. You back tested your setup, and it's when this moving average crosses over the next moving average, you buy the next bar, right? So, you know, you start thinking that the one trade didn't work out, then the second trade didn't work out. Come trade 3, you say, well, the other 2 trades didn't work out. Maybe I'll just take a little bit more time and see if this trade's really going to work. Well, now it's 2 or 3 bars later. You say, oh, yeah, it's definitely going. You get in, and guess what? The market's just getting ready to do a normal pullback, and it could be still going in the direction that you were intending it to, and the pullback knocks you out of the trade because you didn't have proper trade location from your strategy that you back tested. Very important to be consistent with your approach. All right, here's the 4 pillars of money management and what I think that a trader needs to look at. The first one is going to be reward to risk ratio. Very, very, very important, guys. The next one, the probability of a trade setup. You know, what's the probability that you're going to make money? Because if you have a, let's say, 5-to-1 risk to reward ratio, which is great, I mean, that would be excellent, and the probability of a trade working out is 1%, well, that's not going to make you money. I mean, you might have a great reward to risk ratio, but, you know, you're going to go broke sooner than later. The next one, your win-loss ratio. And the next one, your position sizing. Here's another one. This, I would honestly have to say, guys, if I had to prioritize these, reward to risk ratio and your position sizing are the 2 most important components. You know, if I had to rank highest to lowest, those 2 would be in the very, very top. Too small position sizing, you're not going to have the account growth that you need, but you're still be in the game. Too big of position size, and you're going to end up getting margin called and have to put more funds into your trading account in order to continue trading. All right, so here's a little question I have to ask you guys. Which reward to risk ratio is best when day trading? Now, you want to focus on the day trading aspect of this, guys. Is it A, reward 20 pips, risking 60 pips, which is a negative 1-to-3 reward to risk ratio? Is it B, reward 20 and risking 20, which is basically a 1-to-2 inverse risk to reward ratio? Is it C, 20-20, which is a 1-to-1 reward to risk ratio? Or is it D, your reward is 40 pips, you're risking 20 pips, 2-to-1 reward to risk ratio? Very good. Or is it E, you're going to make 60 pips to lose 20 pips? So go ahead and type in the chat box, guys, what you guys think the correct answer is. Man, it still never amazes me. We have a few people got it right. Let me just double check this real. That's good deal, James. Let me see. There's a few of you guys that got it right, but there's a lot of you guys that, in my opinion, got it wrong. And the next slide, I actually got it wrong. I just seen there's a typo. So the next slide, I put it's C. But actuality, the answer is really D. It was just a typo on my part. It's all right, Keith. You know, it just takes practice. And you'll see, this is going to really open your eyes during this presentation. This first part you guys have seen, but when we get into the charts, it's going to be an eye-opening experience for you. Now, here's why E is the best answer, a 2-to-1. We have to look at the 4 pillars of money management. Now, but first, okay, but first, before I give you the answer, okay, I got one more question for you guys. What win-loss percentage is needed to break even with a 2-to-1 reward to risk ratio? Go ahead and type that in the box real quick. We'll see how many of you guys remember this, because we had this slide before. This slide's been around for years. Let's see. I'm actually, a lot of you that have been in there for a while got it right. The answer is E, guys. It's actually 34 point something percent. It's actually E. So let's think about that. You only have to be right less than 4 times out of 10 trades, and you'll still be making some type of profit. All right, so here we're going to do a little coin flip to reward to risk ratio, okay? If we flip a coin 10 times and it lands on heads, we make $1. If it lands on tails, we lose $1. Flip the coin 10 times. If it lands on heads 5 times, guess what? We break even. Now, how many traders, if you're not consistently profitable right now, does this fit your trading account to a T? If you're not losing money, a lot of traders are stuck right here, breaking even, because they're so tied up on their win-loss ratio that they're missing the bigger picture in front of them. Here's another example. Oh, in the example above, once again, we have a 50% probability of the coin landing on heads or tails. It can only do one of two things, guys, heads or tails. Let's say we landed on heads 4 times. Now guess what? We lose money. That's not good. We don't want to lose money on a weekly, monthly basis. We are going to have down weeks, and hopefully next year we don't have any down months. We didn't have no down months this year, so let's go strive for that again next year. All right, now let's look at the 2-to-1 risk-to-reward ratio. We're going to do that same thing. We're going to flip the coin 10 times. We make $2 every time we're right. Yeah, you're right, Joe. It's that cold medicine again. So Joe is actually really keen on that. And that was a typo too. Joe said we actually lose $2, which is absolutely correct. Remember, guys, I told you guys I was on some cold medicine. So you'd actually lose, because if we did the math, right, we would lose $6 and we'd only make 4 back. Appreciate that, Joe. It just shows I'm human. I do make mistakes. I'm actually very nervous at presenting, and that's why I like to do webinars and talk to people. It helps me face my fears a little bit. Trading's the easy part, Joe. All right, now we're going to flip a coin 10 times. If the coin lands on heads, we make $2, and when the coin lands on tails, we lose $1. Now that's a scenario I want to be involved in. In this example, we have a 50-50 probability of it landing on heads. If we land on heads 5 times, that is a 50% win-loss ratio and a gain of $5. Now see before we broke even. Now we're actually making $5. Now I know you guys are probably thinking, and that's why we're going to go into the charts here shortly, that okay, well the market can do more than just go up or down. It can go sideways. And that's very true. The market can go sideways. But if the market's going sideways, if you're not trading options, you're not losing money. And if you sold the options, then you would actually be making money. So if the market's going sideways, you're not losing anything. You can reassess the situation and see if you want to stay in the trade or move on. Now, if we land on heads 4 times and tails 6 times, we have a 40% win-loss ratio and a profit of $2. Now, imagine this, guys. You place 10 trades. Only 4 of them are right. You make money on 4 of them. 6 of them lose, and you still make $2. Yeah, it doesn't sound very appealing. Go out there and tell everybody, yeah, I got a 40% win-loss ratio, right? But guess what? You can be proud of yourself that you're actually making money in the market. It's not about winning every trade. 3-to-1 risk-to-reward ratio. Once again, we're going to flip a coin 10 times. If it lands on heads, we make $3. If it lands on tails, we're going to lose $1. At the end of 10 flips, it lands on heads 5 times, we make $10. Now that's great. But when day trading, we can't. It's going to be very hard to put your stop loss and your profit target in a place where it can hit your profit target without hitting your stop loss on a consistent basis, without going to the really higher time frames, 240, daily chart, and stuff like that. Now let's say we land on heads 3 times. We would still make $2 with a 30% win-loss ratio. So that's great. If you're trading off a daily chart, shoot for a 3-to-1 risk-to-reward ratio. But when you're trading intraday, you're going to find it's extremely, extremely difficult. And that's one of the problems that scalpers have, guys. If you look in the futures market and stuff, most of those guys don't have a 3-to-1 or a 2-to-1 risk-to-reward ratio, because when you're scalping, it's so difficult to not have your stop get hit, but your profit target get hit without having too much risk out there for the market to really take advantage of you. All right, I will show you later that in the market, it's not best, that this is not the best risk to reward ratio. We have a 50% probability of each setup working out when market noise is factored in. All right, so you need to familiarize yourself with this chart right here, guys. This chart is very, very important. The chart on the right shows how much of a gain is required to recoup losses, okay? So look, if we have a 10% drawdown, we only have to make 11% to get back to break even. Hey, that's great. But look what happens. You start losing 50% of your account. Now you need 100% return in order to get back to break even. You start getting to 70, 80%, let's say 80%. You have to have a 400% return just to get back to break even. If you lost 90%, you're looking at 900%. Now, let's say you did do it. How long do you think it would take you to have a 900% return? It's going to take quite some time, to be honest. I'm not saying it can't be done, but honestly, you'd have the odds really stacked against you. And that's why it's a must that we keep our losses under control, or else our psychology will get the best of us, myself included. When I first started trading, I'm telling you guys, I was a wild man. I was a gunslinger right from the hip. Boom, boom. I mean, I was in and out of trades up until I'd probably say 6 years ago. I was still placing anywhere between 200 and 600 trades per month. I mean, I was trading a lot, very, very active. I didn't want to miss a move. I want to make sure I got every move. And you know what? I found that when I was placing more trades, I actually made more money when I started taking less trades. It's kind of a funny thing how that works. All right, here's a strategy with money management. Our strategy is going to be a MACD crossover, and this isn't the one that made the money that I showed in the first slide, guys. The one that I showed in the first slide is truly going to blow your mind. Our strategy is going to be a MACD crossover with all 5 money management scenarios applied over a 1-year time frame. And this is an old slide. Some of you guys have seen this slide before. This strategy will open a new position once MACD has crossed over and open a new position at the open of the next bar, as long as there is not an open position already. Do not trade this strategy. It's only for an example, guys. I don't think a moving average crossover, a stochastics crossover, or MACD crossover all by themselves have any significance. All right, so here's the example right here. MACD crossed over right here. It crossed over on this bar. It bought here. Profit objective was reached. Oops. Hold on real quick and move my slide thing, guys. Okay. Here's the next one. Same thing. We got in the trade here. MACD crossed on this bar. It got in here and it got stopped out for a stop loss. So I want to show you guys what a win would look like, what a loss would look like. Okay. Now here it is to the downside. We short MACD crossed. It shorts here. MACD actually crossed on this bar, so it shorts it here. Profit target hit. That's what we want to see in our trading. Profit target hit. Here's another example. MACD crossed right here on this bar. The market entered this bar, stopped us out. Boom. Again, 2 losses back to back. All right. This isn't a live account. This is just a pre-made strategy and trade station that I plugged in just to show you guys. And this is going back years and years. All right. So here's what the results are going to look like of each of those scenarios. So with a reward of 1 and risking 3, we're going to lose right here $5,200 over 1 year. So, that's definitely not what we want to be involved in. All right. Now, look at our win-loss ratio, guys, right? A win-loss ratio is 73.77%. So hey, that's great. Go tell everybody, yeah, I got a win-loss ratio of 73%. Because when they ask you how much money you made, if you're being honest, you're not going to be able to tell them a positive number. You're probably going to want to dance around that question a little bit. Now let's look at this one. A risk. We're going to have one reward to risking two. On this example, we are risking 40 pips to make 20 pips. Notice our win-loss ratio is still above 60 in terms of small profit. So our win-loss ratio is 67%. We made $5,000, which isn't bad. But I think if we ran this over a longer period of time, this would actually be a losing scenario. Okay, now let's do a 1-to-1 risk-to-reward ratio. Remember that 50% trader, guys? Look at our win-loss ratio. Our win-loss ratio is 49.5%. And look, we lost $4,622. Not very good. Not a very good setup at all. That's why we must make sure that we have a positive risk-to-reward ratio. All right, here it is again, guys. These examples are on a 15-minute chart, all of them all the way across the board. All right, same exact time frame and everything. All right, in this example, we're risking 20 pips to make 40 pips. Look at this. Made $11,918.70. Hey, look at our win-loss ratio or percentage, 35%. That's not great. Go tell everybody, yeah, I made 35%. My win-loss ratio is 35%. They're going to laugh at you and tell you how terrible of a trader you are. But hey, if you made $11,000, hey, I'd say you're doing pretty well. You can always scale up the lot size. Remember that. You can always trade more lots as you make more money. The more lots you trade, the more money you're going to make, and it's just all about percentages. Next example, 3-to-1 risk-to-reward ratio. Now in this example, we're risking 20 pips to make 60. That sounds great. Our win-loss ratio is 24%. We lose $5,000. Now you may ask yourself this, why is this like this, right? The 3-to-1 risk-to-reward ratio is talked about in all the books about how great it is, and that's what you need to do to be a successful trader. Well, our 2-to-1 risk-to-reward ratio, and this is all applied to the same time frame, the same chart, illustrates the purpose that a 2-to-1 is actually better. When you have market noise, you need to make sure you can be far enough away from the market noise, but your target can be close enough to where it's a high probability that that target is going to be reached before you're actually taken out from your stop loss. Not filled very often. Hey, Kashmir, what's not filled very often? Your target or the stop loss? Stop loss always gets filled. May not be at the price you want. Oh yeah, target. When you have a 60 pip target so far away, which is kind of funny because the next example I'm going to show you towards the end of the slide is actually going to go off a 60 pip target, which is really going to blow everybody's mind, all right? So look, here in this 3-to-1 risk-to-reward ratio, we can't hit 60 pips a majority of the time. But watch at the end of the slide, and we're going to show it in current market conditions on the last one, guys, on the last, when we go over the charts. It's going to be pretty amazing, eye-opening. All right. So I've already touched on this reason, in my opinion, and this is just my opinion of why a 3-to-1 risk-reward ratio is not good when day trading. The normal fluctuations are going to stop you out more than you're going to be right. This is part of where the probabilities come into play. When we flip the coin, 50% is going to land on heads, 50% is going to land on tails. All right, you can have a run where it lands on heads 10 times, or it can land on tails 10 times. All right, but it's going to do one of two things. The fluctuations in the market, how the market is moving is going to stop you out more than it's going to hit your target. Because if the market can go up 60 pips, it darn sure can go down 20 pips just to stop you out in a normal move, all right? A normal move. All right. So I believe that everyone here can make profitable trades at least 35% of the time. Do you think that that's a true statement, guys? That each and every one of you in here have the ability to be right 35% of the time? I do. I mean, it's pretty easy. All right, the steps I teach typically have a 40 to 70% win-loss ratio when applied correctly. Now, the strategy I showed everyone was a winning strategy when proper money management was applied. All right, so even if you just did the MACD crossover that I just showed with a 2-to-1 risk-to-reward ratio, you're going to have a lot of losing days. but over the course of a year, it would make money. I do not advise you to go trade that strategy. There's way better strategies out there to trade than that. Alright, now every week I speak to traders that say it's so hard to get 40 pips and a 2-to-1 risk-reward ratio. I showed only using MACD, no fibs, no moving averages, no pivot points, no volume, or any other tools that 40 pips could be attained with a 2-to-1 risk-reward ratio in a few slides back. So there's no reason why you have to have yourself believe that it's impossible to reach. I showed you the results. I didn't hypothetically say well, maybe we would have got in here. When it's in the computer only knows yes or no. The computer doesn't have the logic that we sabotage ourselves with. It can be done. I would like to see each of you go back over your journals and check to see what would have happened as far as your P&L if you had a 2-to-1 risk-to-reward ratio. I think that you'll see that you would have had a lot more of a positive impact on results than what you currently are achieving. Now, position size, and in my opinion, a trader should not risk more than 2% max on any one trade. Now, I've actually updated this, guys. In my own trading account, I'm not risking more than 1% per trade now. And you may say, how are you making any money? Well, it's actually I'm making more money now than I was before, and my stress level goes down a little bit more. Even at 2%, I didn't have much of a stress level. When I first started trading, I was definitely risking a lot more than I should have. Now, just because your broker will give you higher margins, let's say 400 to 1, does not mean you should trade with a $300 or $400 account and trade 2 or 3 mini lots. It's a statistical fact that everyone, including myself, is going to have 10 losing trades in a row at some point in time. Let me take a drink real quick, guys. All right, so if you don't think you're going to have 10 losing trades, go play some trades in the market over a long enough period of time. And you'll have 10 losing trades at some point in time, and you'll feel like there's nothing you can do right. All right. So if a trader, excuse me, I'm losing my voice. If a trader risks, let's say 5% per trade, that would be a 50% drawdown. Remember that slide we did before, right? So if you lost 10 trades, risking 5%, you lose 50% of your account. If a trader risks 10% per trade, that would be 100% loss. Hey, guess what? The game's over until you add funds to your account. You can't trade no more. You don't have the ability to have any more opportunities in the market at that point in time. So let's go back and look at that chart. 50% of a drawdown, we have to make 100% of account growth in order to get back to break even. 100% loss or broke, obviously. But this 10% to 20% is kind of the sweet spot. You can recover this fairly quickly in the market. Last week alone, or not this week that we just finished this week, the week before, I actually had 11% increase in my account that month, or that week. This week, not so good. We still made a profit, and our signals, we started off the week extremely well. I had 108 pips right off the rip on Monday, and I think we finished out with 68 pips. The pound skunked me a couple times in a couple trades, but I still ended up with 68 pips, which is well below what I wanted. That was a terrible week for me, but I just came off an extremely good week the week before, so you have to kind of expect it. And if you would have taken trades off the bias, which I did in my personal account, just using the bias, because some of the other trade levels weren't hit yet, I went ahead and I had some other trade setups. I made more than 68 pips, but I didn't hit my 200 pip quota for the week. And most people are going to come on here and tell you, oh, I hit my quota every week, I'm always better. Well, I'm not. That's just a fact. Sometimes you're not going to hit your goal, but you have to look at the week before, and I really excelled past my goal the week before. All right, let's think in percentages, guys. This is very, very key. So what if on the same 10 trade scenario, we risk 1% to make a 2% gain, right? 10 losing trades in a row would only be a 10% drawdown. That's not bad. We'd only need 11% to get it back, just like we showed in that previous slide. Now, let's say you win 4 out of 10 trades, right? So you're only going to win 4 trades. You would have a 2% gain on your account per week. Now, real quick, guys, does 2% sound very good to you guys per week? Because I know if you guys go look at your inbox, you can get 1,000% per week, 1,000,000% per week. Does 2% sound good? Well, let's put it in context. Now let's think about this. If we only manage to win 4 out of 10 trades for 52 weeks, our count's going to be up roughly 104% for the year. It's not that hard to achieve. It's just how many trades do you pump through there, right? So it's just a matter of I got to put more trades on to let the probabilities work out. Yeah, that's very good, Joe. That's with no compounding. I always like to give more conservative numbers, so that's why I didn't add the compound in to make it look, sexier, dress it up. I give it out just how it was, assuming that you didn't increase your position size. Now think about that. That's only a 40% win-loss ratio trader right there. You still have the ability to grow your account 104%. That's pretty darn good when you think about it. Now, here's another benefit when trading using proper money management. Time frame of chart is irrelevant. I think that was a bad slide. Oh, I know what I was trying to get at. So here's another benefit when trading using proper money management. A time frame chart is irrelevant. It don't matter if you use a range chart, a Casey chart, a candlestick chart, a line chart. That doesn't matter. Once you have good money management, it's so easy to place a trade. You're not scared anymore. All right. Now we're getting ready to get back to the good stuff. Does anyone believe we could just buy at a random time and make money using good money management? I want to see some answers in the text box while I get another drink. I want to know if we can just pick a random time of the day and just buy and use good money management. We could. This one must be stumping people. I only got a few answers. Probably no, yes, no, 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 no. All right, a few yeses, break even. All right, so this is where it's going to, we're going to see, all right? We're going to see. So here's going to be the strategy. Here's a warning. I do not trade this strategy. Let's see if he's in here. Yep. One of the guys that I talk to all the time, real good friend of mine I met from the trading community, is actually in here. And this is what I was trying to prove to him. I don't trade this way. This is just, I wrote this strategy just to prove to him how important money management is. All right. So here's the strategy, guys. Buy every day at 9 a.m. Eastern New York time as long as there is no open positions at that time. So if we bought, let's say on Monday at 9 a.m. and the market was flat and our stop loss or target wasn't hit, we're still in the trade, we can't place another trade. If we got stopped out, hey, we can place another trade. If we took profits, we can place another trade. All right? And we're going to do this over, let's say, a 10-year period of time. Now, we're going to set our profit target at 60 pips and our stop loss at 30 pips. That's a nice 2-to-1 reward to risk ratio. Everybody would agree, right? We showed how when day trading, that's a very good reward to risk ratio. All right, so let's go into the charts real quick. So before we get started, here's going to be a chart of the euro, US dollar, right? So would you guys classify this as a downtrend or an uptrend? Remember, we're only going to be buying, right? And that's a good question. Why did I pick 9 o'clock? The reason I picked 9 o'clock was because, those of you that have taken the IB course from years ago, what was my favorite time to look for IB bars? I just picked a time in the market that there could be a lot of volatility in the market. I could have just as well have went ahead and looked at London or whatever. Okay, so most people are saying downtrend. Euro's been in a downtrend. Okay, so let's look at the pound. What about the pound, guys, over the last 10 years? This goes back 10 years from today, is all the way back here. You would have to say it's a lot lower than it is higher, correct? All right. And let's pick this one. What about this one, guys? That's probably going to get pretty ugly, and I'd have to assume, right? I mean, if you look at this Euro Aussie on a weekly chart, it went from 2.1 all the way down 1.16. I mean, that's a big move down. It would have been nice if I could have shorted. I did catch some of this. I caught, I don't know, I think it was right up in here I caught, and I watched the rest of it go. I missed the first part. I caught this little bit, and I thought I was doing pretty good, and the market just, wow, it went a lot further than I thought. Okay, so now what we're going to do is I wrote the program in there to go over the example. We're going to look at the euro. This is a euro back here on a 60-minute chart, guys. We scroll back all the way. I had to pre-populate this. This took a long time on this computer to download all this data. So here it is right here. Right here, the market, this 60-minute chart. Buys here, profit target. Buys here, profit target. Buys here, profit target. And it'll start having some losing trades. Well, let's go and see. View strategy performance report. Let's just go see what it does. Oops. It made $37,000 over the course of that. Now remember, you guys just looked and said the euro was in a downtrend, right? It was in a downtrend and all we did was buy. All right, let's look at the chart. I gotta scrunch this up a little bit. Let's look at the chart real quick. Performance graph. There's the chart of the euro. And this is using a 2-to-1 risk to reward ratio. All right, and if you don't believe so, let's look at our average winning trade, $600. 601. Our average losing trade, $300. That's a 2-to-1 risk to reward. Yeah, $10 per pip. That's what TradeStation has defaulted at, Joe, for their automatic strategies or whatever. So that's pretty darn good. Let's see if it tells us. I know it tells us somewhere. It tells you account size. Account size required would have been $11,000, $11,940 something dollars to have that type of gain. But the point isn't necessarily how much money it made. I could have dialed it up to 100 lots. I just used what TradeStation had pre-populated to prove the point that this chart right here that we just said, this euro chart, well, there's not going to be a strategy on that one, was in a downtrend. Right? The market's been going down, and we were buying every day at 9 o'clock. Buy, 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 buy. And it made money. All right, now let's go look at this pound. I can't remember. Oops, no, pound's in the downtrend. I got pound 60. View. Why did I pick a 60-minute chart? I didn't. I can't. 15 minutes to load all that data was just too extremely difficult. All right, so here we are in the pound. Pound had a little bit of drawdown, consolidates, goes down a little bit, it pops back up. It has its runs. Remember, it's still profitable, guys. It's not a strategy I trade, but the whole point I'm trying to get into, you guys, is showing you the money management aspect of it, okay? Look, again, our average win, $600. Our average loss is $300. It's not bad. Let's look at the next one. Euro Aussie. That was a chart. Remember, this is that chart right here, Euro Aussie. Get that ingrained in your head right there. And we'll go look at that 60-minute chart view. I can't really remember which one was the highest. Might be this one. $48,000 on that one. Let's go see what that looks like. It was underwater for quite a period of time, but if you stuck with it, boom, it trends up. Remember how bad that thing pulled back? So at the worst drawdown that you had, I would say, was roughly 11,700 bucks was the drawdown, and it's been as high as, actually it might be high right now, 48,400. It's not bad, right? Again, let's look at the risk reward ratio. Not risk reward, average win, average loss. So our average winning trade was 531 because this isn't $1 per pip, and your average lose was 247. So not bad, right? That's with a 2-to-1 risk reward ratio, guys. That's very, very, very important. So let me go back from current slide. All right, so all right, now what about a journal, guys? If you're not journaling, how are you ever going to know what you need to improve on? What days you trade good? You know, you're not going to know what setups are working best for you. You're not going to be able to see what time of the day you trade better. And you may think that that's a joke, but, I typically trade best on Tuesdays and Thursdays. This is when I close out a majority of my profit. How that usually works, I have no idea. But that's just from me journaling, knowing and understanding that. Also, I've looked at when I've had, more, trying to get like a 3-to-1 risk-to-reward ratio, or even a 1-to-1 risk-to-reward ratio, or even in the past, I've even been a victim of having negative risk-to-reward ratios. And you may look like you're doing great when you look at your win-loss ratio, but as soon as you get that little bit of a drawdown, it really, really croaks your account. So one must make a journal like my partner Scott and I do, and we always journal our trades to see where we can improve, what we've done good, and you have to be able to look in the mirror and say, wow, I really messed this trade up. Go back and look over that trade. Him and I have a funny joke all the time when we have a bad trade. There's a certain day that we lost a lot of money in one day. He lost a lot of money that day. I lost a lot of money today. We took almost the same exact trades. I mean, it's really funny looking back at it now. But, I look at that day and how I had a colossal, meltdown that day. And so did he. And, I always go back and study that day and say, wow, I really messed that up. And if you look at the chart now, it's like, you just shake your head. You don't even know what you're thinking that day. But again, that's when psychology gets the better part of you. It was years and years and years ago. It was probably, what year are we in now? I'd have to go back and look at my charts, but it was over 5 or 6 years ago. But, I made that money back that I lost in that one day in a short period of time. How much? It was about $11,000 in a day. Yeah, it wasn't a good day, but, things happen. I also made more than that in a day before, so, it is what it is. All right, so journaling, you'll find, we talked about that. Do yourself a favor and journal. Now, real quick, guys, before we end this, all right, here's kind of what I used to use for journaling. I've had this for years. I had it in Excel. I imported it into Google Docs a while back. My computer crashed, and I lost some of my trade data, so I was a little upset. But what I did is I went ahead and built in account risk size calculator. So if you want to risk, if you have a $10,000 account, you want to risk 1%, then and you have 50 pips, well, this tells you right here how many lots you should be trading. If you have a mini account, it'd be 20. If you have, if you have a micro account, it'd be 20. If you have a mini account, it'd be 2. Standard lots, it'd be 0.2. Now, here's the beauty of it. Here's what I used to use. I kind of switched it up a little bit. Here's all the months: January, February, March, April, May, June, July, August, all the way till December, right? So what it'll do is it'll give you a monthly total over here, and it gives you your total for the whole year over here, then the best days of the week that you trade. Now, here's how it works. You may say, what's this cheat sheet? Well, in order for me to get this to work, and this was years ago, it was a little complicated for me. So let's say we go to January, and we're trading the euro. I put euro US dollar, and we'll say it was 1-5-11. Now the entry, for a long entry, I'd have to put a negative number first. So let's say 131. And here's where that's where it got confusing. So that I had to put a negative number for a long entry. Now let's say I wanted to go ahead and, and when I closed out the trade, I lost money on it, let's say. So that means it has to be a smaller number, right? So we'll go 1.3100, right? You can see over here it calculates I lost 21 pips. But it's kind of weird. I ended up quit using this right here just because it was too much of a pain in my butt. I ended up doing away with the entry and exit for time, because I can go back in TradeStation and look at the date. It has it time stamped on my charts, where you got in, where you got out. I'd put my bias in, my bullish or bearish for the day. Time zone. Time zone meaning, was it London? Was it Asian? Was it New York session? Setup, I would just abbreviate it. It could be double bottom, MACD cross, stochastics, off a level. I have little abbreviations for all my setups. So let's say in this example we lost 21 pips, right? Let's say we're trading 10 lots. Well, that'd be $210 because I know the euro's $1 a pip. You hit enter there. Oops. Sorry. Remember, we had a losing. It was a loss, so you have to put a negative there, right? So I'd hit that, and you can go back and look on our sheet. In January, we're already down 210 bucks. Mondays, not looking so good for us, right? So, you can see this all at a glance, how good you're doing right here. And I meant to give this out years and years ago when I was doing this. I never got around to it. I never had enough people that I could get to truly start journaling their trades. I'm actually going to be going back over and changing this because there's some more stuff I want to put in it for 2015 that I want to switch it up a little bit. In 2015, though, I'm probably going to take the entry and exit out where it calculates it, because all last year, I didn't use it last year at all. I ended up just calculating how many pips it went manually and then putting in how much money I made on each day. Now, let's say the next trade, you enter the date, the pair, all that, and let's say the next trade didn't happen until Thursday. Let's say you made $1,000, right? You go back over and you can see how it transferred over to here. January, we're up 790 bucks now. Thursdays are a hot day to trade. And at the beginning of the year, it takes a little while for you to start seeing what the best day of the week is that you trade. Mine's Tuesdays and Thursdays for whatever reason. And actually, I've had some really good Fridays, like after Tuesday and Thursday. Friday's my next best day to trade. And those of you that know me for a while, I hate trading Fridays. So how Friday ends up being the day that I close out so much profit, I have no idea how that works. It just happens to be, how the ball bounces. Now, I lost my train of thought. Okay, so let's clear this out real quick. Now, you may say, well, okay, that's great. I can track how much money I made on the trade. Let's say, this is the same example. We lost 210 here. Comment. Entered trade late. Okay, so when the trade's over, I just put myself a quick note so I can say, what did I do? Was it some of my comments, guys, if you went back and looked at my trades even years ago, even some of my profitable trades, I didn't even have a setup. I just had an intuition about the market, which way it was going to go, and I put no trade set up, bad, and I'd highlight it. That way I knew that, I need to break that habit, and I have broken that habit. I feel very, very confident about where I'm at in my trading career right now. I mean, I'm definitely leaps and bounds ahead of any other time since I started trading. And this has helped me. I'm not sure how to share this on Google Docs. I have a copy of it in Excel because that's when I first started using it, was in Excel. But then when my hard drive crashed, I was a little upset that I lost a little bit of my trading data. So I think I lost the first 3 or 4 months of the year of trading data. So if anybody wants it, you guys can send me an email, and I can always send you the Excel version of it that I have. I can just email you the template. I do plan on doing some updates to it, though, but, if it's something that you'd be interested in, just shoot me an email, and I can make sure I send that to you guys. All right, do you guys have any other questions? Oops, I just canceled. Okay. Thanks. Yeah, my voice is actually starting to go out now. It's starting to having a little bit of a hard time talking.